Hi folks, please go to the disclaimer. Today we're going to talk about what are the best time frames for investing. We'll compare returns for different time frames in the market. Uh, and you'll see a very interesting pattern right here. So most people think that market operates in two time frames. Basically the first 15 minutes of the market, which is the pre-open session, and the next major part of the market 9:15 to 3:30 p.m., which is the market hours. And both of these are the intraday part of the market. And the third time frame basically is that of the closing part of the market, when the market is closed. But that's actually the most important one for generating returns, the time between 3:30 p.m. to next day morning at 9 a.m. So the market pause that happens during this period, which is the overnight market basically, uh, why this is the most important time frame for investing, that we will see in this video. Please remain uh, please watch this to the end of the video to understand this concept completely. So the shocking data that you see here is that the average overnight returns in the last 14 years is 27.1%. So if you had theoretically bought every day morning and sold every day close intraday, you would have lost 16%. This that you see here, average intraday loss. If you had bought at close every day and sold at open every other morning, you would have gained 27.1%. So the significant data points towards that intraday play is not geared towards a lot of returns, at least not on an average basis. I'm sure there are people who are still making money intraday, but largely your playbook is geared towards losses, whereas overnight playbook is geared towards gains. So whenever you have a situation where by not doing anything silly, you could still make a lot of gains, that is the overnight market. And in intraday, you really have to do something special to make sure that you are not making losses. So there is a very big difference between the two. That overnight, even if you are not a super investor, if you are an average investor, you will still make gains. But in intraday, if you are an average investor, you will lose money and you will need to be a super trader to make money within the intraday period. And this is also not the complete picture actually. The complete picture, if we see, is that average uh, now there is a difference between what was happening before 2011 and what happened post that. So before 2011, intraday was generating more significant returns than overnight. Very surprising data that is coming out. You can see that average intraday was 13.5%, whereas average overnight was 5.8% only, and similarly for the median also. And if we look at 2011 to 2025, here the tables have turned where average overnight became 27% and average intraday went down to minus 16%. So very stark difference between the two periods, and we'll try to decipher what is happening here. So what is this anomaly? Why market changed their behavior post 2011? What is the current trend of internet overnight or intraday? So let's use 5-year rolling returns CAGR chart to understand some of these concepts. So this is the 5-year rolling return CAGR for Nifty from the year 2000 to 2025. So you can see uh, the red line, which is the 5-year overnight line. So if you were doing the overnight play, this would have been your 5-year rolling returns. If you were doing the intraday play, the blue line would have been your rolling returns. And overall Nifty 5-year rolling returns is this orange line, which you can see. So you can see that for this part till 2011, intraday and Nifty returns were very much in line, in sync, uh, and overnight was nowhere in picture. Whereas after 2011, overnight returns became big and intraday returns collapsed while Nifty remained sort of near the double-digit mark. Now, phase one, if we were to go deeper into this phase, what happened from 2010 to 2011, 2000 to 2011, why intraday returns were higher than overnight returns, and why there was an intraday euphoria. So one could, and all this is hypothesis basically, basis several research pieces found on the internet. So the derivatives F&O market started picking up post 2000, and 2003 to 2008 was a massive bull run in the markets, and a lot of traders leveraged very big during that period to speculate during the day. And turnovers really went up. You can see turnover just going ballistic in this time frame, uh, of 2003 to 2008. Also, FI flows has started to increase in a way never seen before. So FIs were investing $2 billion, and then suddenly 6, 8, 10, $17 billion. So huge amount of money coming through. And in the second phase, we had overnight do much better than intraday. And the second phase, the first phase here switched into this other phase, uh, post 2011. So likely that, a lot of new players uh, uh, emerging at this point. 2008, 2009 global financial crisis happened. Many of the highly leveraged local speculators from phase one got wiped out. So whoever was making money in this phase actually got significantly wiped out during this period. And new players emerged post GFC World 2010 onwards, saw more dominant set of players. And after 2008, also the foundation was laid by SEBI and NSE with direct market access and co-location facilities, where a lot of HFTs and algorithms came into the market. So till this point, there were hardly any algorithms in the market. People were trading intraday, making money. And this was the period where, uh, you know high frequency trading algorithms, companies like Jain Street, etc., entered into the market. And there was a lot of intraday sort of focus that happened on a algorithmic manner, which was absent during this period. And hence, a lot of folks were doing intraday trades and making a lot of money in this period. And post 2010-11, that gradually was lost. So quant systematic funds, data driven strategies were exploring market inefficiencies. And FII's flows into India also turned more systematic and model driven, mirroring quant trends. So these high speed systems basically dominated the intraday session, and that eroded the manual trader's edge, and that may contribute to intraday losses. Also, when we compare to other countries, whether it is US, S&P 500, Nasdaq, Canada, UK, France, Germany, Netherlands, Norway, everywhere we find that the returns overnight are much, much greater than the returns which are there intraday. So this is a global phenomena that people who invest overnight make much more money than people who invest only intraday. And if you were to think about it on a very simplistic manner also, intraday used to, I'm not sure what is the limit now, but I remember in 2003, 4, about 35 times your capital you could trade. So if you put up 1 lakh rupees, you could put in a trade worth an exposure of 35 lakhs or something near that. And that was virtually a sort of a free ride. So people who don't have money would want to play intraday. People who had the 35 lakhs would want to invest and take delivery and uh, stay for a longer period. So as they say that, unless you will invest your capital, how will you make money over it? Some people, of course, will make money in intraday, but more often than not, if you are not investing much, then you should not be expecting too much returns out of it anyways. So this also is very true across all countries, where those who are actually putting up their capital, taking overnight risk, are getting rewarded, whereas those who are not putting up any significant capital, not taking any overnight risk, in for the very short term trade, are not able to make that kind of return. And then post 2010 also, more efficient and faster systems were getting introduced, and market efficiency was going up, and it's the same phenomena as other countries India was also experiencing. And these are the possible explanations of this phenomena as per some research papers from Vasiliki and Basedeko. And the explanation here is that the momentum and reversal idea. So overnight hype. So big news like earnings or global events usually comes post market hours, and it causes the price to gap up or gap down at the open. And then these gaps are usually overreactions, and smart traders tend to fade these gaps. By fading it means you start betting against the opening move. So you closed here, you opened here, but then the algorithms will start to sell this gap up, and fade this gap up. So the computer programs, basically the automation in algorithms, basically enhanced this methodology of selling at open if market is gapping up, or buying at open if market is gapping down. And this resulted in automated sort of fading, selling into strength, buying into weakness. And this basically has pushed the intraday session negative, because most of the uh, you can say the crux of the move that happened overnight between the close and the open, and the resulting intraday was just sort of reverting back to the mean kind of situation. The other explanation could be the big player strategy. And research suggests that big institutional players, they sometimes what they do is they will buy at open with very small volumes. And because opening markets don't have that much volume right now, so if you buy at the open with very small volume, the price really jumps up, and that can be sold through the day. Once you've established a new price higher, then that gets sold through the day, and higher volumes, basically you can sell higher volumes through the day without crashing the price. So this creates sort of positive overnight returns, low close and high open, and negative intraday returns, high open, going towards lower closes. So these are hypotheses. Some may be right, some may be wrong. But what is very interesting to see is that again is starting to dip. The overnight returns since 2022 have again started to dip, and intraday returns have again started to rise. You can see on the right side of the chart here that the trend is again starting to move back. And there again, maybe the hypothesis is the major sell off by FIs have started in the last few years, and FIs and algos, which drove phase two, are essentially creating the divergence where all these automated algorithms that were there are also not um, thriving anymore. Some of them are actually going out of business because of the rules of the game having been changed. SEBI's new peak margin rules, which phased in 2020, 2021, and T plus one market settlement have fundamentally changed the market. So the change in the market and the effect is that these rules dramatically reduced intraday leverage for all players, whether it was algos, prop desk, or retail. So again, this part of the market that was, very very highly competitive in nature in intraday, many players have moved out, and hence whoever is left behind is starting to see some better days than before. That is the hypothesis that is being trying to make. So for investors, of course, uh, this is all noise, because I mean they are not looking at intraday at all. They're just looking at longer term trends. So markets have a lot of anomalies, but the patient SIP investor who stays invested, ignores intraday moves or overnight noise, ultimately wins. Patience wins because it allows you to ignore the noise of what is changing. So I've shown you that there are some undercurrents that changed in the last 15-20 years, but because you as a longer term investor, who's not dealing with intraday noise, uh, is actually not impacted by this at all. and it's only the intraday players and the people who are um, involved in the market from minute to minute basis. They are the ones who basically, and you would have seen in your own circles also, a lot of people would have come into the markets in the last 5 years, and several of them have left as well. So that cycle will continue to happen, and basically we have to ignore this noise and make sure that our strategies, which are longer term in nature, uh, continue to perform well. Some of these market regimes that come through, certainly they are not permanent. What strategies that worked in phase one was destroyed in phase two. The strategies that worked in phase two was fading in phase three. So the anomalies will keep coming and going, but the discipline of compounding stays. You stay the course, you stay invested, and not worry about these changes that are happening in the market system. Now, the also the underlying theme is also to sort of emphasize that um, while overnight money is always making much more globally um, than intraday money, there are, however, a lot of strategies, intraday strategies, leverage strategies that can make significant amounts of money. So I'm not at all saying that intraday systems don't make money, but on a general basis, you can say aggregate basis, most investors who will take a longer view will automatically find themselves that unless they do something really silly, they will make money. And most intraday investors, unless they are really at the cutting edge of intraday trading, they will continue to lose money. So let me know in the comments how you like this content. And have you ever noticed such market anomalies in your investing or trading journey? You can watch these other videos from our channel as well. Certainly do subscribe to our channel and do like and share these videos. Thanks. Bye.